Hello and welcome to the show. I am Puneet Wadhwa. Today we have with us Abhiram Eleswarapu, CEO and Head of India Equities at BNP Paribas. Hello and welcome, Abhiram.
Morning, Puneet. Nice to meet you again.
Same here. What's your outlook for the equities for 2023, Abhiram? Can the markets actually give a negative return as they battle economic slowdown and recession?
Yes, Puneet, to answer that question, we need to consider the three main factors that will drive the markets next year. First and foremost is growth, and broadly, we expect growth to slow across the board, especially in developed markets. And we expect a mild recession in both the US and Europe. Maybe India may not have such a huge impact on growth, but still it will be a little slower than what we've seen in the past couple of years. The second element is inflation. Now that while that is coming somewhat in control, it still will remain above the comfort zone of most central banks, in our opinion. And therefore, next year you will still continue to see tightening by central banks globally, even if not at the same level as we've seen this year. So slow but steady tightening until inflation is within the comfort zone. And last but not least, on valuations, mostly when we look at equity valuations, we try to compare them with bond yields to see the relative attractiveness. And unfortunately, that attractiveness has shrunk quite a bit. And in fact, on a relative basis, bonds are looking more attractive than equities. And probably that attractiveness will only increase over the next few months as rates peak globally. So, in a nutshell, in developed markets, we expect a significant downside to equities, maybe 15 to 17%. Across emerging markets, we expect a modest return that is positive. But I dare say a lot of that may be driven by China reopening. And therefore, India, while we do not have a formal target for the index just yet, I think that a reasonable assumption would be that you will either have flattish markets next year or maybe even some downside.
So 23 belongs to the bulls or the bears, according to you?
As an asset class globally, it will belong to the bears, in my opinion. In India, it will be a bit of a tug of war between both parties, and I dare say the bears may just slightly win it.
Okay. Can you elaborate on your stance for India?
Okay, so in India, what we have to consider is the earnings growth forecast for next year are somewhat optimistic in the sense that they do not factor in a significant downside to risk to growth. That's one element. Then some of the valuation parameters, actually that's the critical element in India is always that, because growth is maybe a little downside to that, but the risk will come from the fact that the market's trading at maybe 20 times next year's earnings, as opposed to the historical levels of 15 to 17 times. And when you take a bond yield minus earnings yield calculation, it comes to something like minus 2.3, minus 2.4. These are levels we've not seen in the last 15 years. And in fact, whenever it has breached that 2.2, 2.3 mark, after that, the returns have been negative over the next 12 to 18 months. So we are in that kind of a scenario. I mean, the mathematical equations are not in our favor for equities at the moment. So the best case scenario probably would be a modest upside, and that's purely on a relative basis that there's no growth elsewhere.
So within the broad equity space, do you find valuation comfort anywhere within the large caps, mid caps, or the small caps back home?
The most comfort that you find on valuation slash growth matrix would be on financials. I think banks are pretty much a consensus call, but I still think that valuations are still very much on the positive side or in favorable side. And also, credit growth has been pretty strong, irrespective of deposit growth not matching up. You have a supportive central bank in terms of liquidity. So I think banks in general will do well. So will insurance, especially life insurance and other companies. There are some near-term headwinds there, but by and large, it's a structural story. Two other sectors that I like. One is IT services. Yes, there is a demand slowdown globally, but I think some of that may have been factored into the valuations. And also, even if there is a further downside because of a mild recession elsewhere, you would probably have very minor earnings cuts. I would say below 5% kind of earnings cuts. And considering these are good managements backed by good dividend yields or buyback programs, I think IT services is not a bad place to be. And the last is healthcare. It's not only a structural story globally, but also in India.
23 also, Aviram, is peppered with a lot of state elections. Can that be a joker in the pack as far as the markets are concerned if they start extrapolating the outcome of those elections to what may happen in 24?
Well, historically, what we've seen during elections times is a near-term impact at best. Ultimately, I do not think that that will be taken into account when you take a 1 to 3 year view. Having said all of that, there tends to be a general slowdown in capex just before the central elections. Maybe 6 to 8 months before that, you may see some impact. But then investors will also be aware of the fact that this is a pre-election kind of a slowdown, and they may actually factor that in when they're looking at India from a longer term perspective. So while you're correct, and I tend to agree with you, I do think that that may be probably a few weeks or a few months impact rather than a longer term impact.
So, what is the road ahead for flows, both domestic as well as foreign, into equities, Indian equities?
So, I mean, if you look at this year and try and understand the texture of flows this year, the first half of the year we had very weak, or we had outflows from foreign investors. In the second half of the year, that started to pick up. A lot of that flow was driven by the theme of, sell China, buy India, because India was the other large alternative available for those flows. And also, India offers a lot of good quality companies at the end of the day for foreign investors to buy. So that was a theme that played out, I would say, for the past 4 to 5 months or so. But also, India has outperformed significantly compared to China over a longer period, maybe about 18 months or so. Typically, that kind of outperformance does not last that long. And now we're trying to see, what we're seeing is China is reopening very gradually on a
Correct.
weekly basis. We're getting some positive news flow or the other on reopening. So my fear is that some of that outperformance may reverse, and the trade of buy India, sell China may reverse. So that's one aspect on flows. The second aspect is what happens because of central banks globally tightening even more, and perhaps what happens on the side of quantitative tightening as well. If all of that comes into play, then the outlook for flows may not be as positive as we've seen so far this year, at least in the second half of this year. So that's on the foreign side. On the domestic side, I still think that flows are reasonably healthy. Over the last couple of months, though, we've started to see some slowdown even on domestic and retail flows. And retail investors have been significant participants in the market this year, but they're also becoming more educated, and they do understand valuations are now maybe above comfort zone. So I think that there will be some general slowdown in both domestic and foreign flow, but I still think that domestic flow will be the more predictable and healthier kind of flow.
Have you started jotting down your budget wish list, Abhiram?
Well, not yet, not yet. But look, ultimately, the whole story on India is about growth, right? And growth comes from both the public side and the private side. And the public side is in the control of the government. And this year, I think their collections are going to be pretty strong. Not only has a modest inflation situation helped collections, but also the economy has recovered faster than expected. So I think they will be in a good position to increase capex. And I just want to take a better look at the financials of the government before I say further. But if there is a wish list, it's about increasing capex, and certainly on railways and on the engineering side, we're starting to see that happen quite a bit. Defense, for example. So I'm just hoping all of that continues.
And nothing on tinkering with tax rates, LTCG and STCG? Well,
we've seen some news articles around this point, but at this very early stage, I really do not know. I do not know if that is indeed the case. But again, back to the point that I've made, collections have been pretty healthy. So whether you want to make wholesale tinkering or wholesale changes with tax rates around equities, maybe it may not be needed just yet, is what I think. But if you want to harmonize, rates across asset classes and how you classify short-term and long-term, taxation, then that's a different story. But at the moment, I don't see an urgent need to do that.
Thank you, Abhiram, for joining us today. We hope to see you soon.
Thank you, Puneet.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.